Sensible Money was ranked #1 in Arizona and 16th in the nation for firms with assets between 500 million and 1 billion, and ranked 81st among all firms nationwide by USA Today. And no surprise to any of us who work at Sensible Money, we've again been named a best place to work for financial advisors by Investment News. The founder and CEO of Sensible Money, Dana, is recognized as one of the nation's top thought leaders on the subject of retirement planning, especially this most challenging phase known as decumulation. She's the author of the widely acclaimed retirement guide, Control Your Retirement Destiny, and her online course, How to Plan the Perfect Retirement, is available at thegreatcourses.com. And Dana, along with firm partner CJ Miller, is about to launch our own podcast and YouTube channel called Making Retirement Make Sense, where you'll find more great content like what we're seeing today. I'm Nancy Fellinger. I'm one of the financial planners here at Sensible Money, and I'm based in South Carolina. Our headquarters are in Arizona, but we have team members in several other states as well. Using some of the same technology that we're using here, we work seamlessly with each other and with clients all across the country. You'll see a question box on your GoToMeeting screen, and we want to encourage you to add any questions to it as we go. There'll be time at the end for questions, and Dana will answer as many of them as possible. The webinar is being recorded, and we'll follow up with a link to it within the next several days. And so now, Dana, let's get started.
Thank you, Nancy, for the wonderful introduction. I was a little slow in following along with the slides as I was having a moment of panic as I got the deadly spinning wheel when I tried to turn my microphone on. Luckily, it came on in time. Just a quick sound check to make sure that is in fact true. Can you once again type in yes? Nancy, can you reassure me that you can hear me? I just want to make sure everyone can hear me.
I can hear you. I also had the spinning wheel for a while, so I'm hoping that it was picked up, but we'll find out.
The deadly spinning wheel of technology. Well, where I want to start today is with a story. And so many of you have followed our content for quite some time, and you see these oranges everywhere in our marketing, and here you see a photo of several of us with the oranges in our hand. And I want to start with how that came about. So years ago, I was talking with a marketing consultant about, how we could describe what we do. And as we were having these discussions, one morning I was at a local breakfast place, a place called Butterfield's, for those of you who are in the Arizona Scottsdale area. And I was watching the oranges roll down this big contraption, and out came fresh squeezed juice. Now, the weekend before, I'd been at home making homemade margaritas, which I use fresh oranges in, and I had been, squeezing them by hand, and there's always extra juice left over in the rinds. And so I was watching this, and I thought, that's it. When you have a professional process, you get more juice out of every orange. And so that's how our analogy came about. And it's relevant to what we're doing today, because those of you who have heard our content on how to plan for taxes and retirement before, well, it's going to be a little different. I really want to focus on how you measure how much more juice you can get. So that's a different concept than just studying the rules. Now, before we dive in, I got to go through our disclosures. We will use some case studies and some analogies in here. As usual, past performance is not a guarantee of future results, particularly with the work we do. Just because we can show some case studies where we were able to offer meaningful improvement doesn't mean those same set of circumstances apply to you. Each household is different. And that is something I really want to emphasize and hopefully illustrate why that is the fact in today's content. So here's what you will learn today. One, what is tax planning? Like, really, what is it? And I'm going to ask for your feedback, so you're all going to have a say on this. What are some ways to measure success? So if we talk about squeezing more juice out of each orange, well, how would we measure that? How would we measure if a decision added value? What are some of the tax basics? Really just how do taxes work? We want to make sure that people understand that, and we have people of all different knowledge levels attending today. As a matter of fact, we had over 1,500 people registered for this webinar. What are some of the changes from the One Big Beautiful Act? We'll talk about those, some of the changes that might be most relevant for upcoming retirees. And what are the actual mechanics of paying taxes in retirement? How does it differ than when you're working? So those should be the things that you have an understanding of by the time we're done today. And I want to use an analogy today on the difference between what I call flying with visual flight rules. Now, I'm not a pilot, but one of our employees has a spouse who is a pilot, so I actually had her run this by him to make sure that I wasn't saying anything too off course here. The difference between visual flight rules and flying by instruments. So when you're flying by instruments, it allows pilots to fly in reduced visibility. They can navigate using instruments and communication with the air traffic control tower. It requires extra training. And this is important, commercial airlines or private charters use instrument flight rules almost all of the time. And this is the key difference between some of the ways that if you are a do-it-yourselfer, you may approach your planning versus what we may do. So as financial planners, I feel an obligation to use a set of instruments to guide the plan. But if you're out there doing your own, it might work just fine, and you don't have that obligation, right? And so it's an important distinction. So we want to illustrate what we do as planners and how we measure that. And some people might go, oh my gosh, like my retirement will be fine without all of that. And that might be true. But as professionals, we need a set of metrics, and we'll be sharing those with you and how we have actually measured success and why I get so excited about it. This is one of the things I actually get really, really excited about, and got excited about almost 20 years ago when I first saw how you could really add value through some of the things we're going to talk about. So we have an attendee poll. I said I was going to ask for your input. What metrics measure tax planning effectiveness? And I am going to launch a survey, and we're going to be asking for all of your input. Is it, do I have more tax? Do I have more left, right, at the end of plan? Do I pay less in taxes? Is my situation more secure? Can I spend more on what matters? Or is it all of the above? So I have launched that poll. It should pop up, and you should be able to put in your answer. And we're going to give everybody about 30 seconds or so, and then we'll be able to share the results. And Nancy, I'm curious, do you see the poll pop up for you?
I was afraid you're going to ask. I've got everything separate. Yes, I do see it.
Okay. I see answers coming in, so I know everyone can see it. It's great. I love the participation.
Wow, yeah.
Yeah, and lots of answers coming in. I can't see the total number of attendees, but I see well over 400 people have answered. So there's got to be quite a few people joining us today live, which is wonderful to see. All right, I still see some of those answers changing. I see people have found the poll. There's still more answers coming in. We'll give you about 10 more seconds to participate. And here we go. So sharing the results, hopefully everyone can see that. And if you can't see the results on your screen, 84%, so 417 people said all of the above. What a surprise, right? We would measure success by multiple factors. And I would agree. Some people want to focus more on, can I spend more? Some people prefer security. Is my situation more secure? And do I have more left? Well, if I paid less in taxes, that should naturally lead to either having more left or being able to spend more on what matters. Now, these are what I call the human questions. And so here you see these human questions, but we also have the metrics, right? And today we have people all across the spectrum of, just retirees or people planning for their own retirement who just want to answer these human questions. And then often we have much more sophisticated attendees. They're either fellow advisors or they're do-it-yourselfers or engineers who love getting into the details, and they're going to be interested in the metric side. So listen for what matters to you. We're going to try to provide content that addresses both sides of these. When I look at the measurements of do I have more left, well, I have to have a way of measuring that, and we measure that by after-tax values at the end of the plan. And by end, typically we're running our plans in this case study today for a 30-year time horizon, but depending on, if you're retiring at 55, it might be a little bit longer time horizon. If you're already over 70, it might be a little shorter time horizon that we're using. But did the decisions we make likely result in having more after taxes? And the reason it has to be measured after taxes, because if we're implementing something like a Roth conversion strategy, then I have to look at the value of the remaining assets after paying taxes, and I'm going to pay more taxes on the pre-tax IRA, 401k, 403b type money. But we also have to look at things in terms of nominal and real. And I'm going to explain that in a minute because it's kind of a confusing term, right? Nominal is just the dollars we see in our account, but real is, do they buy the same amount of goods and services? And so if I have $1 million in 20 years, well, it's not going to buy the same amount of goods and services that $1 million buys today. Do I pay less in taxes? We have to look at the present value of estimated taxes paid over the lifetime and the break-even point. So what if I pay less in taxes over 30 years if I really didn't break even until year 25, right? I paid more taxes until year 25. Well, that wouldn't make so much sense. Do I have more guaranteed income, and did I have to use less of my money to achieve the outcome? And while doing all of this, did I still retain enough to protect me in my later years? So I might be able to spend my portfolio down at a reasonable pace, and that is the goal of many people. But I have to hold back enough that if I need long-term care or extra assistance in my later years, that there's still a sufficient amount left to cover that. And then there's metrics that we use to measure these, what we call liquidation value. That's the after-tax value, and you'll see that in both nominal and real dollars. There's present value calculations and break-even charts. There's fundedness and coverage ratios, and then there's a way of comparing plans and metrics. But all of these fancy terms are designed so that us who do this professionally can answer these human questions. And we need an instrument-based system to be able to do that. Now, I mentioned nominal versus real, and I've thought about this a lot because I know some of you are like, yeah, Dana, I got it. But many people are like, these terms, I don't know what they mean. So I thought, the best analogy I can think of, it's like backwards inflation. So we'll see an example shortly where we have someone who, after taxes, is spending $80,000 a year on their living expenses. And this is what it looks like when that goes up at 3% a year. So we're basically saying 20 years from now, we're going to need about $140,000 to buy what $80,000 buys today. Now, there's some various research, and we see this in our own practice. We have retirees we've worked with since 2001 now, where typically retirees don't need their spending to go up at the same pace as inflation. And so these numbers might not go up as rapidly, but for the sake of our analogy today, we're going to use 3%. Inflation has been in the news a lot. We've had higher inflation in the last few years than we did for almost a decade prior. So we'll keep it at 3%. Well, what is present value? Well, $80,000 is the present value of $140,000 20 years from now. That's the simple way to think about it. So when we talk about present value, we're saying, all right, well, in today's dollars, what is this worth? If I had $1 million left in my account 20 years from now, well, what is it worth in present value dollars? Or if I'm paying taxes each year along the way, well, how much collective taxes did I pay in present value? And you'll also hear the term discount rate. Well, discount rate is just what is the rate I'm using to discount this back to the future. In this analogy, the discount rate would be 3%. Now, there are different discount rates we might use for different calculations. If I'm looking at the total value of your assets and trying to determine what that is worth in today's dollars, I'm probably going to use a 3% discount rate. But if I'm looking at portfolio metrics and withdrawals and the likely rate of return that your invested assets might earn, I'm going to use a 4% discount rate. Still, in many people's eyes, that is very conservative, but we like to be very conservative. When you're planning for retirement, it is much better to each year end up slightly ahead of where you thought you would be than to get 10 years into retirement and go, oh my gosh, my assumptions were far too optimistic and I'm going to be in trouble. So our preference is to err on the side of conservatism and then each year adjust and be able to ratchet things up as they turn out, hopefully a little better than what our projections modeled. So to illustrate some of these factors, we're going to walk through a case study. Now, you can find a lot more details in a paper that is available under the materials section. Now, I'm not exactly sure how you find that, if it's called a handout or materials, but if you click around in your control box, you should be able to find a place to download this. And it's a very technical paper. So if you're falling on that engineer, love all these metrics and this geeky stuff, then you might really like it. The paper has a very technical, geeky title, Demonstrating Advisor Gamma Through the Household Balance Sheet. I wrote it in 2021. Now, the case study I'm going to walk through today uses basically the same factors, the same sample household, but adjusted and updated for 2025 and 2026 tax rates and slightly different Social Security and asset amounts, but it's approximately the same case study. So we're going to look at this couple, John and Pam. 2025 is their last year of work. And first, their initial plan, hey, we're just going to claim Social Security right at retirement. We don't think we're going to pay much in taxes in the first 10 years, and we'll show you why they thought that. And this is our visual flight plan, right? We're just going to go along and we have enough, and they do, and we'll be fine. Then we're going to say, well, what happens if, we have to start by actually accounting for taxes. You claim Social Security at retirement, just according to your plan, that's fine. But let's account for taxes. Let's make sure we factored that in correctly. And their taxes aren't exactly going to be zero for the first 10 years, although it makes perfect sense why they might have thought that. And then we're going to have a scenario 2B where they spend more, and I'll explain that as we get into it. But then we're going to say, well, what if you are willing to follow a custom Social Security claiming strategy? And I might, if I can remember, stop using terms like delay or early and just refer to custom. Because when we talk about custom, oftentimes it's having one person delay and one person claim even a year or two earlier. Sometimes it's one person at 70 and one person claiming at 62. Sometimes it's not fully delaying until 70. It is a customized strategy based on that household's economic financial situation. So I think I like this term a little better. And then we're going to look at custom Social Security with Roth conversions, and my numbering is off here. That should technically probably be 4. And then we're going to look at custom Social Security claiming with Roth conversions and asset location, meaning, well, normally in our case studies, I want to assume the same rate of return on every scenario. And the reason I do that, I think of it as like the doctor's motto, first do no harm. Can I identify the strategies that can improve outcomes without tweaking the portfolio? Because we don't often have control over the market returns. We can do everything right. We can follow a disciplined and diversified plan, but depending on what time in history we retire into, we could get market returns that are on the high end of historical averages or on the low end. So even if we do everything right, there's just certain things we don't have control of there, which has always been my pet peeve with people who want to run plans and just magically tweak the whole portfolio and have it earn more and say, look, if we do this, you can be fine. But I can implement asset location, which says I'm going to tuck the investments that are likely to earn a higher rate of return into your Roth, and we're going to not tap that for the first 20 years of retirement. And then I'm going to be spending down this other account in the first 10 years. And so it's going to earn a lower rate of return because I'm spending it rapidly, and I probably need to invest it more conservatively. And so in our base scenarios, we're using 5%. We're assuming all accounts earn 5%. And in our asset location scenario, I'll explain, we're assuming that the asset location model, the Roths earn 6%. The non-retirement account, the one we're drawing down first, is earning 3%, and the IRAs are earning 5%. And then we're going to look at the scenario of, can I spend more if I've used this, what I'll call instrument flight-based plan? Can I spend more, and how does that compare if I just spent more under my visual flight plan? I can't say that right now, flight plan. So here we go. Here's a sample of the visual flight plan. We see John and Pam, they are at the end of 2025, 65 and 64, and this is their last year of earned income. They will be claiming Social Security toward the end of this year under their original visual flight plan. And then here's what they would be receiving. Now, you'll see a change down here at the bottom highlighted, and let's see if I can get my own highlighter on. Yep, right down here. At 85, we assume John passes away and that Pam continues to live for several more years. And so we see one of the Social Security amounts disappears. The lowest earners Social Security no longer continues, and the highest benefit amount is what continues as a survivor benefit. But we also see over here what happens is John's IRA rolls over into Pam's IRA. She continues to have required distributions. And because she has less Social Security now and continues to have higher required distributions, she's going to have to take a little bit more out to supplement that. And that could either come from a Roth IRA or from the non-retirement account. And so and in this case, their starting plan, they don't have any Roth IRAs. And then at the top, we see their values. So these were their starting asset values at the beginning of 2025. John had about 710,000, IRA, 401k, 403b, 457. We're using IRA to refer to any of those pre-tax account types. Pam had about 1.1. They had about 978,000 in a brokerage account that could be titled as a trust, a joint account. It might have come from an inheritance. It might have just come from them saving over the years. And this, we call this an NRA, non-retirement account. So it's our way of just coding all of the assets that are not tucked inside some kind of tax deferred or tax preferred wrapper. You get a 1099 on any non-retirement account. Each year you pay taxes on the interest, the dividends, the capital gains as you go along. So here's their initial cash that's available on a gross basis. And we see that it's going up each year because we have inflation factored in. And these numbers that you're seeing on this screen, if you just remember, 138, 147, well, they're going to match these numbers of outgoing cash, 138, 147. So here's where their money's going, right? They have housing costs. They do have a paid off home. And so this is primarily real estate taxes and insurance and maybe some maintenance and routine maintenance and upkeep. Here's the living expense numbers that we used in my analogy on what present value is. They have some auto expenses, vacation, healthcare related. These we have increasing at 5% a year. And then here's where they assumed they would pay no taxes for their first approximately 9 years in retirement. And once again, down here, we see some changes. So there are some baseline assumptions we typically use where living expenses, when we have a sole survivor, drop by about 15%. And then, of course, we no longer have 2 sets of out-of-pocket medical costs, 2 sets of health insurance premiums. So those go down a bit. We don't have 2 sets of Medicare Part B premiums, but taxes went up. And we talk about this as, a case that it applies to couples. If you're a single listening, these factors don't apply to you. Your situation and projecting some of these factors does become a little simpler because we don't have to factor in some of these differences that might happen. But taxes go up because now we have someone filing at single tax rates. And so all of that has to be factored in. And then here we see what we're really solving for is after taxes and after big ticket purchases. We don't have any of those in this plan, but what are they spending on a monthly basis, or what are we solving for? And here we see those numbers coming in, and we see them generally increasing with inflation. Now, you'll see a little dip here from 2027 to 2028, and that is coming from these healthcare related. What happens is as they transition from a Affordable Care Act plan where they're paying out of pocket for their plan on to Medicare, their costs are actually expected to go down a little bit. And so that's why you see that change happen in these few years. We have each of them going on to Medicare, and then we're seeing those adjustments factored in. So why did John and Pam think they would pay no taxes? Well, here are the 2026 brackets. Now, one of the changes that came through from the One Big Beautiful Act, I don't know if I got the name right, but the recent Tax Act, there is a new expanded 10 and 12% tax rate, and that is factored in to here. So we're seeing these tax rates here. And we're seeing that if most people know, but in case you're just here for the first time learning the basics, not all of your income falls into this marginal rate. So if you're a single and you're earning between 105 and 201, well, the income that falls in this range is taxed at 24%, but you still have income falling into these other ranges. And sometimes to account for that, we use something called an effective tax rate that we'll look at in a few slides. And then over here, we see the married brackets. And so we might think, well, why did John and Pam think they would pay no taxes? Well, let's go back a few slides. Whoops, not that many. We'll go back to here, their withdrawals. So their plan was to say, we're going to start Social Security. We're not going to touch our retirement accounts until required minimum distributions begin at 75 for each of us. And we're going to just draw down these trust or brokerage account assets. Now, one of the things you have to factor in is what are the capital gains? So we get all kinds of questions at the end of this webinar and questions that are emailed to us. Hey, I just want to know, should I do this or that? And sometimes people are frustrated by all of the questions we ask back, or we'll answer, it depends. Well, in their case, about half of this is appreciated value, unrealized capital gains. That could be from index funds. Sometimes we see it from concentrated stock positions from someone's employer. Sometimes it's an inheritance they received a few years ago. They invested it, and in the last few years, the markets have been quite strong. But for every dollar they sell here, about half of it is going to be a realized capital gain. And they knew that. But they figured, okay, maybe about $40,000 of capital gains, and we know not all of our Social Security is taxable. At maximum, 85% of our Social Security is taxable, so that's going to be about $47,000 of taxable Social Security. And so we come back here to the tax brackets, and they go, well, yeah, this is going to be under 100,000, but most of it's capital gains. Now, when we look at the qualified capital gains and dividend tax rates, we see that as a married couple, you can have up to $98,000 taxed at the 0% rate. As a single, almost $50,000 taxed at the taxable rate. And so they figured most of their capital gains were going to be taxed at 0. And they also knew about the deductions we get. So if we look at this, this is taxable income that you're looking at here. Well, you start with adjusted gross income, and then we have these deductions that you can take. Well, in 2026, there's a slightly expanded standard deduction. If you're single, you get to deduct $16,100. So the first $16,100 of taxable income you have, well, it's not actually taxable because of this deduction. If you're married, it's $32,200. And we have the standard age 65 or blind additional deductions. So if you're single, you can tack on, and you're over 65, you can tack on a $2,050 to this. If you're married, it's $1,650 each that you get to tack on to this. And now, starting in 2025, this year to 2028, it's temporary, we have the new senior bonus deduction. And so that's $6,000 each if you're over 65. Now, this deduction has a income threshold. So if you're single or head of household, you will get the full deduction if your modified adjusted gross income is less than 75,000, and then it begins to phase out. And so by the time your modified adjusted gross income is over 175, you've lost this $6,000 extra senior deduction. If you're married, you get the full deduction. If your adjusted gross income is less than 150, it begins to phase out between 150 and 250, and you would expect to receive none of that if it's over 250. And we have a new charitable deduction for those who don't itemize. So that's $1,000 per person. If you're single and you donate to charities, you no longer have to itemize to get the deduction for that first 1,000. If you're married, that means you could do 2,000. Well, in our John and Pam case study, they assumed, okay, we have 32,100. Oh, excuse my math here. I think it's 32,200. One of these is wrong. I'll have to see which one had the typo in it. We have the 65 plus deduction, that's standard, and the new senior bonus deduction. So they figured they'd qualify for all of that. That would offset their taxable Social Security, their capital gains wouldn't be taxed because it would fall into the 0% rate. And so it's reasonable that they thought, we won't pay any taxes for 10 years. That's pretty cool. But in reality, we had to go in and factor in that you are going to realize a substantial amount of capital gains each year because you're having to sell assets that are appreciating in that non-retirement account to fund the cash flow you'll need. And so when we actually plug it into the tax calculation here, well, you are going to pay taxes. And it's not a meaningful amount. They're still going to have plenty, right? But better to have factored it in. And I think of that as step one in tax planning. So we talk about what is tax planning. Well, the first part of it is just accounting for the taxes that you'll have to pay and realizing how much it can depend on the types of investments you own and how long you've owned them, how much cost basis you have, your composition of IRA accounts to non-retirement accounts. All of that impacts the answer. But there's one other thing we see here. And so we see that there's slightly more income taxes in year 10, this is when the RMDs begin, than in their visual flight plan. And it's simply the fact that we had to add in some more realized gains that year. And so that pushed a little bit more of their Social Security into the taxable range. When we look at the first 5 years close up, 2025, here's what it looks like while they were working. And so we see some of the deductions. Now, the extra senior deduction, I don't know that that's pulling in here in 2025, so that's probably an error I have to fix. But we see here in 2026 that they have these extra deductions here. We see their estimated total federal tax. We see their top marginal rate. They also have state taxes that they can expect to pay. But one of the things they have to factor in is up here we have ordinary income and net qualified gains. And dividends are included in this. And so when you have a non-retirement account, a brokerage account, we don't talk about this as much, right? We talk about IRAs and we talk about Roth conversions a lot, but you also have to accurately factor in the taxes on brokerage account assets. Each year they're kicking off interest, dividends. Sometimes mutual funds generate what we call embedded capital gains at year end. So they do a distribution in the fall, typically November, December. You don't have control over that. That is different than realized capital gains where you choose to sell shares. And so some mutual funds, when we talk about a fund that is less tax efficient, it's often because it may have a very active type of trading strategy, which means at year end, it's likely to kick off a significant amount of embedded capital gains, which can throw off your tax strategy. But the way you invest is going to impact how much shows up in this ordinary income, taxes interest income, versus qualified dividends and capital gains. And in a simple example, this was something we ran for a client who had sold a business this year. And initially they were thinking they really wanted to stay conservative, invest all the funds in CDs. Well, their federal tax rate will be 35% next year. They will be subject to the 3.8% net investment income tax. So you'll see a footnote at the bottom sharing the income thresholds when that begins to apply. And then they're going to have a state tax rate. So every dollar of interest they earn in a CD is going to be taxed at 41.5%. Now, something of interest, treasury bills or treasury bonds, the interest is state tax-free, whereas CD interest is not. So if you live in a state, New York, California, some other states that have very high income tax rates, that's something to consider. There could be a case for using treasury bills, treasury bonds instead of CDs for the safe part of your portfolio. Now, if they're investing in funds that they expect to generate primarily capital gains and qualified dividends, well, the federal tax rate will be 20%. In their case, they'll still be subject to the net investment income tax, potentially state tax, 26.3% tax rate on each dollar of investment gain. That's a big difference. Now, how you invest has to be factored into those long-term projections. And so we will often ask for tax returns. One of the things we're looking at is the character of the investment income that's flowing through to that tax return. The other thing we have to factor in is if we're going to be initiating some substantial changes to the portfolio, will that change that character of the income? And how do we adjust the forward-looking projections to reflect that? So back to John and Pam. Well, we have some key metrics that we talked about. And I'm actually going to pull over a planning model, sample case study for John and Pam, where these metrics come from, and walk you through that, because I think that's going to be the easiest way to illustrate what's happening. Now, hopefully, this is going to work. So, can anyone tell me, Nancy, I might need your help here, because when I pull this spreadsheet over on the screen, it looks like it's showing up, but I can't actually see what everyone else can see.
So, so I can see it. Fine.
Great.
And I don't see any questions or concerns about not being able to see it.
Perfect. Yay! I love it when it works. Okay. All right. So in John and Pam's model, here we see their earned income coming in here. And then we see their Social Security. So we have a timeline across the top, and we see their Social Security beginning. And then we see all of their expenses. We see the 80,000 that, we showed before, and then the taxes and insurance and all the various categories of expenses. We can see healthcare is kind of grouped together. We have out-of-pocket health insurance premiums, Medicare Part B and D premiums. Now, these are automatically calculated by looking back at the adjusted gross income estimates 2 years prior. And many of you know, some of you may not, that if your income crosses over certain thresholds, then you will pay more than the base premium for Medicare Part B and D. It's called some means testing. You'll hear it called IRMA, the income related monthly adjustment amount. And then we see all their income taxes in here. Now we start blue is all their non-investment inflows, and we're projecting that all the way out for 30 years. And then we have the peach color. This is all of their outflows. This is what we are solving for, like lifestyle. What do we want to be able to spend? And so it has to include taxes, because each dollar we withdraw is going to have a tax impact. We have to account for that. And so here we see that, and that goes all the way out. And then down here we see the gap. We call this the gap. What's the difference between the blue and the peach? And this tells us what we would need to withdraw from our portfolio each and every year. And then we have this metric that we call fundedness. And fundedness takes the present value of those withdrawals. So I have to translate these withdrawals that I might have to take out here. $270,000 sounds like a lot, but what is that in today's dollars? And so we translate that back in time to today and say, okay, it's going to take about 2.388 million using a discount rate of 4%. And what they had is 2.8 million at the beginning of the year. And this ratio is one of several metrics we use to measure outcomes. If we have 118% ratio, now that metric is going to capture most things we change in the plan. If I change something that makes them pay more taxes or has their Medicare Part B and D premiums go up, for example, I do a Roth conversion this year, and that means they're going to pay more Part B and D premiums in 2 years. Well, that's all going to get factored into this metric. Now, that is one of our measures of, is my situation safer? Am I more secure? If I can improve this metric, then I had to use less of my own money to have the same outcome. Another metric we use is this coverage ratio. And so here we like to look out at age 75, and I got to go back up. Oh, I don't have my ages showing. But age 75, I think their coverage ratio is right around 32 or 31%. And so that's a measure of how much of my total outgoing cash flow is covered by guaranteed income sources, whether that be Social Security, pensions, annuity income, anything that we agree falls in the guaranteed category. The more guaranteed income or the higher my coverage ratio, it's another measure of security. So if I think about what it might be like, and there's a reason I look out at 75, we've worked with clients throughout these phases. And as you get into some of those later phases, sometimes people's decision making isn't as clear. There's quantifiable studies that show that our financial decision making does decline as we get older, our ability to think clearly. And so the more guaranteed income you have, the more protection you have. Right? What if you decide to do some crazy things with your money? I have seen this happen. What if you decide to suddenly give a lot of it away? You might lose your spouse, and we've seen people fall for romance scams where suddenly they're, providing a lot of assistance to someone new in their life. So just having more guaranteed income provides more protection. So that's another one of our measures of coverage ratio. Then we have liquidation value. So here is their projected trajectory, and we have John's traditional retirement in blue. It passes along to Pam in the dark green, and then we have their brokerage or non-retirement account assets. Again, they don't have a Roth in their base plan. Now, this is just their total financial capital here. Well, what it doesn't account for is the after-tax impact or present value. So if I scroll down, and I look at the end of their plan, I can see that Pam is expected to have about 2.29 in pre-tax assets remaining. They'd have about 814,000 in their brokerage, non-retirement account. So a total of about 3 million, about the same amount that they started with. But after taxes, it's worth about 2.486 because this IRA is completely taxed, whereas this non-retirement account would be eligible for a step up in cost basis for the heirs. And so there would not be any meaningful taxes on it. And then, well, a lot of people will go, oh man, I don't want to wait until just pass along $3 million. But you have to think about what is that worth in today's dollars. And that's what this present value number is. Ignore my numbers over here. This present value number is in today's dollars after factoring in inflation and what are the amount of goods and services that would buy. It's equivalent to having about $1 million in today's dollars. And so you do want a buffer. And so Pam is in her later years, 30 years in the future. $1 million should be, in today's dollars, should be sufficient to cover any later life needs that she has. But you wouldn't want to take that down too far, or there isn't enough buffer there. So that's our liquidation value. And that's our net present value of liquidation. And then when it comes to spending, well, I'm going to show you a section of our model called the household balance sheet. So this is all discounted back net present value to today's dollars. We have our assets, they own a home free and clear, their financial capital at the end of 2025. The reason you're seeing a different number is we were previously showing values at the beginning of 2025, and this is where it would expected to be worth at the end of 2025. And then the present value of their Social Security, just under 1.2 million. And then over here we have their spending. Now, if I add up these first four categories, it's a little over 3 million in present value dollars. So discounting it back at 3%. And that number isn't going to change in our various scenarios. But we have healthcare related expenses that includes Part B and D, and that number can change because it will be impacted by our tax strategy. And we have taxes, and that number can change. But when we compare spending, we're going to say, well, let's leave the spending the same in all of the scenarios except for spend more. So let's see if I can get back to my regular screen. Yay, I think it worked. Here are our key metrics, and then there's some underlying factors that we're going to look at that are all going to be factored into those metrics. What amount did we convert to a Roth? What was our pre-tax versus post-tax? How much in capital gains did we have to realize? Part B and D premiums. Now, the one factor we haven't touched on is break even. So let's look at that. Here are 5 of our flight paths compared. The blue flight path is their visual flight plan. This was their original plan, and it looks fine. They retire with about 2.5 million, and 30 years later, they probably still have about 2.5 million. Granted, we have to account for present value. This is nominal values that are illustrated here. If they add in custom Social Security claiming, well, that's the red line. Improves the situation a little, but doesn't break even until out here in 2045. If we add in custom Social Security claiming with Roth conversions, well, that is, and asset location, actually custom Social Security claiming with Roth conversions is our green line here. Well, that breaks even a lot sooner compared to their original plan, right? And then if I add in custom Social Security claiming with Roth conversions and asset location, that is this top orange line, that also breaks even much sooner. It's actually about 17 years is the break even. And then can I spend more? So this is my orange strategy, but now I have spent more, and we'll look at how much more. And so, of course, that's if I spend more, all of these strategies are going to go down. So I'm going to show you that separately. So here, what I get excited about is we can add real value through these tax strategies. And I'll show you why I think it's important. This left more money at the end. We're going to look at all of the metrics to show that it also meant the plan was more secure. They paid less in taxes, allowed them to spend more and still end up in about the same place or actually better than their original plan. There is a 17-year break even here, but that is a reasonable amount when you look at life expectancy. So they're 65 and 64 by all measures. They should still be with us in 17 years. And in our spend more scenario, what we're saying is this allows you to spend more, and we'll show you that in a minute, and still have a bigger cushion later. So you are spending more up front, but you're also leaving a bigger buffer so that should you need extra care or extra expenses in those later years, it's there. And this is why I get so excited about these types of metrics. Here are our spend more flight paths just compared. Their original, this was plan 2B, where they would just spend more. And then their customized Social Security Roth conversions asset location. So here we can see if the goal was to spend more, well, this customized instrument guided plan allowed them to do that and have a bigger cushion for potential longevity hedge for more assets remaining toward the tail end of the plan. Now, when we put all this together, this is my ugliest slide. It's a little bit crazy. And I know we're coming up on an hour, so we're going to rush through these last few slides and then open it up to Q&A. But here are all the metrics in our dashboard. Here we have liquidation value. And we can say, okay, as I move over to adding some of these customized elements, after taxes, I have a lot more left using an instrument guided plan. Net present value, well, yes, even in net present value, I have more left. Now, what are some of the underlying factors? In these two strategies, they were able to convert 570,000 to a Roth. In this strategy, spend more, only 530. Why? Well, we had to come up with the cash for them to spend more. And that meant sometimes we were withdrawing more from the IRA, or maybe we were tapping into that Roth early on. And this is why one decision can never be isolated from another. They all intersect. Here are some of the underlying factors in terms of how much is remaining in our non-retirement brokerage accounts. We can see in these scenarios, we spent those down, but we had a significant amount remaining in the Roth. And that Roth passes along tax-free. It also is more beneficial for, in a couple situation, one person who might be long-lived as a single taxpayer. Now, here's a factor that I don't see talked about much, but in each case, we had to determine approximately how much in realized gains do we think we'll have. Well, in John and Pam's original situation, they were starting Social Security early, and so I didn't have to realize as much gains in those first 2 years, and so we see this number is pretty low. Now, when I say pretty low, again, they still were spending down that account, and they had stocks that had appreciated by about 50%. So it's still quite a bit. In our custom Social Security claiming, they were delaying Social Security, but not delaying spending. And so we had to sell assets a little more aggressively. That means we had more capital gains to realize. Well, if we add in Roth conversions, guess what? We're going to pay more taxes. Where is that money going to come from? It's either going to come from the IRA, or in this case, we're going to sell that non-retirement account. Again, we see it coming down at a more rapid pace up here. And so we have to factor in that we might realize a lot more capital gains. And so we see these numbers much higher. Now, why would they go down in the can I spend more scenario? So this is scenario 5 with can I spend more added in. Well, because we spent it faster, there weren't as much gains. I mean, that's the reality, right? Sometimes if we're spending down our investments at a quicker pace, there's less money there to generate investment income. And so there was slightly less capital gains. And then this was their scenario, original scenario. We didn't do any Roth conversions or customized Social Security, but if they spent more, well, again, they were spending it at a more rapid pace, so we had to realize gains more rapidly. Now, granted, these are estimates, but these are how the factors all intersect. This is why when people ask us questions, we're like, I don't know, it depends. You know, one person might have most of their assets in an IRA, another one might have very little in pre-tax assets. Maybe they were a business owner, but they have a large trust or brokerage account balance. So the actual factors that apply to you are almost impossible for us to determine unless we know how much you want to spend, how it ties into when you're going to start Social Security, whether you have a deferred comp plan or rental property. All of those things intersect for us to be able to say, yes, did this decision add value or not? Under here, we see their present value of taxes and Part B and D premiums. So again, we can see that if I did custom Social Security claiming without Roth conversions, my taxes actually went up. But if I started to use that as an opportunity to do Roth conversions and I properly located my investments, well, then it has the potential to bring my taxes and my Part B and D premiums down. And same in the spend more scenario. And then in their original plan, they're spending their assets more rapidly. And so they would be expected to have less total taxes than in their scenario where they didn't spend more. Here's our fundedness metrics. And so we can see that those improve, and then we could use that improvement to just say, hey, can I spend more? And still our cutoff, we like to see 110% here in our fundedness ratio. Here's our coverage ratio at 75. And so we can see the metrics in terms of is my situation more secure? And can I spend more? In most of the scenarios, these first 4, we spent exactly the same amount in present value terms, 3.1 million. But in these last 2 scenarios, we spent an extra 250, and most of that spending was front loaded, meaning we spent it in the first 10 years of retirement to do some of the extras, what we call the go-go years. And then down here, you'll see our return assumptions, 5% on all accounts. In our asset location strategies, it was 4% on the non-retirement. I might have said 3 earlier. If so, that was an error. It is 4, 6 on the Roths, 5 on the IRAs. So those are things I get really excited about in terms of how tax planning actually works, what it looks like in action, and how it answers with metrics real questions like, do I have more left? Do I pay less in taxes? Is my situation more secure? And can I spend more? Now, before we open it up, I want to cover a few other really quick changes. These came from the One Big Beautiful Bill Act. There is a new deduction. Actually, it's an old deduction that's come back for mortgage insurance premiums. Probably not going to impact too many people unless you're a first-time home buyer and you have to pay that extra premium because you have less than 20% down on your house. But that can be a little bit of help for people getting into the housing market. There is an auto loan interest deduction. It's 2025 to 2028. There are some qualifications in terms of, once your income gets too high, it doesn't apply, and it's only on the first $10,000 of interest. But $10,000 of interest on an auto loan is a decent amount. We had some fun internal dialogue about people that might be buying multiple cars for kids that would hit this limit. 2026, it's going to be harder to qualify for healthcare premium tax credits, we think. We think it's going back to pre-2021 rules, and the reason I say that is this is one of the items in contention for the government shutdown, so we're not really sure at this point. We'll find out. Well, we're not sure when we'll find out, hopefully before the end of the year. 2026, charitable contributions will be subject to a 0.5% floor with a complex set of ordering rules. So right now you get a different deduction amount depending on whether you contributed cash, for example, versus appreciated securities. So for high income earners or people who donate a lot, I'm an example of this. I opened a donor advised fund for the first time this year to front load some of my charitable contributions into this year, because starting next year, I will lose 0.5% of my adjusted gross income. I won't be able to deduct that portion of my charitable contributions. And in 2026, there's a cap. So again, for high income earners, if you were going to fall on 37% rate, the maximum you can take your charitable deductions is going to be at 35%. So there are some strong reasons, if you are a regular donor, to use a donor advised fund this year. If you like to donate or bunch your itemized deductions by donating every other year, even if this isn't the normal year you might do it, you might front load that into 2025. And we have the new SALT deduction limit, not new, again, old, coming back, but with some changes. So you may be able to deduct up to $40,000 for singles or joint filers. So same limit there, kind of interesting. It phases out as your modified adjusted gross income goes past $500,000. And so that's your state and local taxes. So again, if you're in a state where you pay a high income tax rate, this could be quite beneficial to you as long as your income's under the threshold. Now, one quick thing on the healthcare premium tax credit. When we say going back to the old rules, what do we mean? This is in contention for one of my ugliest slides, I agree, right along with the other one with all the metrics. Didn't have time to make it look any prettier than this. But here, the way it works is if your income exceeds 400% of the federal poverty level, and these are the 2026 thresholds that would apply, then you are not eligible at all for a premium tax credit. If we actually do, in fact, go back to the old rules. The way it works for the last few years is there was a formula, and it basically said the maximum amount you would pay is 8.5% of the second lowest silver plan in your area. Complicated. If you want to dig into it, this website has some great resources for determining eligibility. But what you really need to know is it may be harder to qualify, and it may be a hard cutoff. So it may be a lot more important to make sure income thresholds stay under these limits in 2026, if in fact that's something that applies to your situation. The last thing to touch on before we go to Q&A are actually the mechanics of paying taxes in retirement. So if you're a W-2 wage earner, taxes are withheld from your paycheck, and we don't really think about it. Sometimes we get a refund and sometimes we don't, and you know, it's pretty easy. But as you shift to retirement, things are changing every year. Some years you might be starting Social Security, you might take an IRA withdrawal, you might have sold a stock to fund some cash flow needs. Well, those things impact your taxes. And to avoid an underpayment penalty, which isn't that scary, we'll talk about that, here are the safe harbor rules. If your adjusted gross income was less than 150 the previous year, you're supposed to pay in 100% of the tax shown on the previous year, or 90% of the taxes for the current year. Well, 90% of the current year is harder to know, right? If you have some various things that happen throughout the year, you don't always know what that's going to be. So the safe way to do it is to pay in 100% shown for the previous year. But if you were working the previous year and your taxes were a lot higher, and then your first few years of retirement, they're going to be a lot lower, you might say, well, I don't want to pay in all of this. It doesn't even make sense to lend the government my money during my first year or two of retirement. And that's when doing the calculations to come up with this number becomes more relevant and meaningful. If your AGI was higher, you have slightly different threshold. It's 110% of the previous year or 90% of the current. Note, some states have special rules. We came across one last year for California, where due to a home sale, someone's income spiked over $1 million, and some of these safe harbor underpayment penalties for the state, these are federal rules we're looking at here, but for the state didn't apply, and so that can be kind of scary. But the most important thing to know is it's a pay-as-you-go system. And so if income was incurred in the first quarter of the year, you're supposed to pay the taxes on it by April 15th of that quarter. And this is where people can get tripped up. You realize a capital gain at the beginning of the year, but you don't really think about it. You might have some tax withholding on your IRA. You get to the end of the year, you owe a lot more in taxes, and now you have an underpayment penalty. Even if you paid in the correct amount, you could still have an underpayment penalty, because if that income occurred in quarter one, you didn't pay your taxes on it until quarter 3 or 4 or until filing. Well, those payments are calculated on a quarterly basis. And so the other thing, our tax specialist always reminds me, because my nature is, oh, they forgot that payment, let's double up on the next one. He's like, that's pointless, Dana. It's calculated quarter by quarter. All you're doing is causing them to lose the investment income by making that extra payment in a subsequent quarter. Just start fresh. That quarter will incur an underpayment penalty, and that's the way it is, but there's no sense in trying to double up for the next quarter. It doesn't actually help. All it does is cause you to lose interest income on that money that you could be earning. So there are some things you can do. One, when you realize a capital gain, you need to calculate the taxes that you might need to pay on it. And again, if you're following the safe harbor rules from before, you wouldn't have to worry about this so much. But it is important to think about, because sometimes those capital gains can be large. Your income can be a lot higher than you expected. You can also do IRA withholding, and this is becoming one of our favorite strategies. Is we wait until the end of the year we have a pretty good idea of the tax liability. We can withhold it all directly from the IRA, just like how it happens from your paycheck. It goes right to the Uncle Sam, and you can withhold for your state also. And when you withhold directly from sources like your IRA or a pension or Social Security, then these quarterly rules don't apply. It's basically evened out as if you paid it evenly throughout the year. I'm simplifying. I'm sure there's some tax experts who are going to clarify and say, yeah, you didn't say that quite right. But hopefully I got it approximately right, so you have an idea of what factors to look at. Some key takeaways: what to do: account for taxes, structure withholding appropriately, or set up quarterly payments. Decide what metrics matter to you. Is it spending more? Is it having a more secure situation? We can, and you can, optimize the plan for the metrics that matter. And sometimes, though, it can be difficult to optimize a plan for all of the metrics simultaneously. So if there's one that matters more, that can be a lot of guidance on the types of products or solutions or strategies that fit you. And you have to have a way to analyze options and improve outcomes. Now, you are going to receive, for everyone that attended, a free assessment offer. We are implementing Wade Pfau's retirement income style awareness questionnaire that can help you identify whether you would lean toward safety first types products, whether you prefer optionality or more flexibility in your plan. It's a really cool tool that I am a fan of. And so watch for your email afterward. If you want to take it, it's free, and it can be really useful. Woo, that was a lot. So as usual, we're going to open up to Q&A. Nancy, as you're getting ready, a few other quick things I want to cover. People often ask about our services. If you are looking for year-end tax planning for 2025, it's highly unlikely we're going to be able to do that. So we are currently running on a wait list again. And so, we just wouldn't have the capacity to gather all of the data and get timely answers to you. So if you're looking for an ongoing relationship where you want to know that these strategies are implemented every year, then I would encourage you to inquire soon, and then we would slot you in for 2026. If you are a do-it-yourselfer, here are some tools that I have used, some of them, not all of them. You can run your own 1040 tax calculator. It's a weird name, Dinkytown, but it's where it's headquartered in Minneapolis, Minnesota. How much of my Social Security may be taxed? It's a cool calculator. We use Holistaplan, and then there's some retirement income planning tools that incorporate taxes. If you're like, can I spend more? Larry Kutlikoff's Maxify is designed around consumption smoothing and giving those types of answers. We've talked about Bolden, formerly New Retirement, before, and there's a new one that we heard about called Projection Lab. I haven't used it, but I did visit their website, and it looks pretty cool. Nancy, I think I hear you typing away.
Oh, whoops. trying to be quiet there, sorry. Yeah, so a question that has come up a number of times during the webinar, Dana, is whether the slides will be available. So and then what about the links, because I can't copy them down or whatever. So anyway, there will be a copy of the there'll be a replay of the webinar going out to everyone. There will not be copies of the slides though separately. So those, if there are slides that people really like and they want to copy, they can always do a screenshot. Especially
you could do a screenshot. You can
webinars.
Play the webinar on chipmunk speed afterwards on YouTube once it's posted, and get to the section. We can try to post a lot of these links in the description section once it's posted to YouTube, so those links become readily available in that section. And because I pulled over a live model today, right, like that isn't going to be part of the slides, and so it becomes more difficult to provide the slides.
Yeah. All right. Give me 1 second here because I,
Oh, I see someone who said Pralana retirement calculator. So
okay.
that is one that we've heard about too. Pralana, Pralana retirement calculator for those do-it-yourselfers can be one that is good. For those of you who are new to our webinar, type in a question. No one else can see it. Only we can see it. So your identity remains private. And we do stay on and try to get all our questions answered. And so, or all your questions answered. Sometimes there are so many that it's impossible. Nancy does a great job of screening through them and trying to, consolidate like kind questions into, so we don't ask them over and over.
It was, oh, all right. Based on past experiences, was it more beneficial to do Roth conversions or try to get the ACA credits?
Almost everyone I've seen the ACA credits. And the reason is the ACA credits are truly, free money. It's like someone just handed you money to help pay for your health care. So almost every analysis I looked at, it was the ACA credits. Now, a similar question. Sometimes people will, if I do these Roth conversions, it moves me into a higher B or D premium tier for a year or two. In almost every one of those scenarios, the Roth conversion still made sense.
Makes sense.
And so, some of these answers, we see enough of them. I think of it like same realizing capital gains in the 0% rate. Well, that's truly paying zero tax. A lot of times that can be slightly more beneficial than filling up that same amount of income with a Roth conversion, but sometimes you can do a little of both.
So this isn't really a question, but I felt for this person because, we hear this sometimes. So the comment was way too much info, overload. Sorry, I didn't get a lot from all this. I think one of the things that happens with some frequency is people get into the process and find that there is a lot more to it than they were expecting. There are more variables. It's more complicated, but that's the nature of decumulation. Right,
it is, and that's why I tried to start off the webinar with those human questions, right? You may not want all this info. You may just want someone to help you answer the human questions. And believe it or not, we can do that without overwhelming you with statistics. Right. Nancy is fabulous at that. And so don't feel like you would have to sit through all these kinds of statistics and, be overwhelmed by all of this. I had one client I worked with and there was one graph we looked at every year. That was it. And she just wanted to know, can I gift more? Can I give more away? I want to give to my grandchildren, to my causes. And that's all we did every year was talk about that. We never looked at a single metric. Now I needed the metrics, right? Because I have a professional responsibility to use an instrument-based flight plan, but I don't have to show them to people that don't want them.
Yep. Could you have, we really do try to tailor the conversations and the whole process around what's going to be helpful, right? Can you explain the fundedness concept again?
So fundedness is basically saying, what is the work that my financial capital needs to do in our use of it? And so the paper probably explains it more, but I think of it as, here's what's coming in from not my household, Social Security, pension, it's coming in from the outside. Here's what I want to spend, and here's the gap. Now, if I take that gap, that shows me here's what I would need to withdraw each and every year for the life of my plan to spend what I've outlined. And I want to take that and turn it into a lump sum. Well, what would I have to have earning what return to deliver that stream of cash? And that's really what fundedness is. It's a ratio of saying, well, here's what I would have to have. Let's compare it to what I actually do have. And do I have a positive ratio there? And sometimes you can be overfunded, which is a sign that there would be room to spend more. Or you can be underfunded, which is a sign that, ooh, what I have is not quite enough. What are the changes that I can make that can put me into a safer ratio?
There's a lot of buzz around pre-tax versus Roth contribution. What's your stance on this?
Well, our stance is we use metrics to do that answer. I've had many situations where I'll go in and someone's working, let's say 5 or 6 more years. And so we'll drop in, okay, if they contribute pre-tax versus post-tax, what's the difference it makes? And we try to use the metrics to answer that question. In many cases, if there's only a few years left to retirement, it doesn't make a big difference. But I have seen cases, even with higher earners, where they already have so much in the pre-tax bucket that you wouldn't think the Roth would make sense, but sometimes it does, because their required minimum distributions are going to be large enough later that it's going to push them into, other threshold limits. And so it's a case-by-case scenario to me. In general, I think when people are younger and they're, usually at the lower starting end of their earnings trajectory, Roth makes sense. When your earnings are at their peak, pre-tax makes sense. And in your last few years of retirement, perhaps Roth makes sense. Sometimes you're in a situation where your income goes back down because you want a less stressful job, or if you're a couple, only one spouse is working. The other thing I think is starting next year is that for higher income earners, I think it's 150,000 plus, catch-up contributions are going to have to go to the Roth. So I'm pretty sure that starts in 2026. There was a Wall Street Journal article on it that I read. I'm sure if I'm wrong, someone will correct me in the comments, or they will correct me right now in our chat box. But I'm pretty sure that starts next year.
What software do you use for the metrics? Is it custom spreadsheets or what?
We use our own model that we built, and we go out and test all kinds periodically. So some advisor software that I like Right Capital, I like Income Lab, but we've found that the details that we can see in our model make us better at what we do. So oftentimes with software, I can get an answer, but I don't know why. And I don't know why. What are the underlying factors that made this situation look better? And so we've hired a lot of young people out of school, and when they have to learn this model inside and out, I mean, it. You know this stuff in a way that you just don't gain that kind of knowledge by entering things into a black box. Now, software is getting better and better. And, I think in a few years, there's probably going to be a software package that could do and have the kind of details that we want to see. So far, we haven't found it.
This is not a question, but I wanted to share this with you. Dana, I first heard about you a few years back on a podcast you did with Gene Chatsky as well as Stan Haithcock. Terrific information. I've learned a lot following you in the financial industry these last few years. Thank you.
Thank you. I appreciate that.
What type or what kind of topics are you planning to tackle in depth on your new YouTube channel? Podcast.
Yeah, so some of them are going to be simpler. So for our person who said, whoa, too much info, well, I want to do a basic series on our new YouTube and podcast channel. Some of them are, I want to do that will be super simple. What's a stock? What's a bond? What's a mutual fund, right? And there's a lot of people that have retirement savings that just, would like an understanding of the basics in language they can understand without being overwhelmed. And so I love doing that kind of content. So that's some of it. Some of it will be much more in depth. So the podcast portion that I do with our partner, CJ Miller, we are going to pick specific topics. I think what some that we have already recorded. One is really around the 4% rule, some pros and cons and what we think is better. We're doing one on financial fraud, how to avoid financial fraud. And then we're going to just do case studies. So Amy, one of our partners, and CJ will do some case studies, kind of like what we did today. For some, that might be too much detail. Other people love it. So all kinds of content that we're planning. Some will be shorter, very short snippets on whether it be the news or certain things like how does a Roth IRA work or what's an HSA. So all types of stuff is what we're planning.
Do many people bite the bullet and go into the 2 times or higher IRMA tier for a couple of years?
Some do. And it really depends on, again, their metrics and how much it can improve their overall situation. So some do.
All right. Thank you for the presentation of the spreadsheet model with extra calculations that I've not used. My question, do you see very many cases where Roth conversions work financially when receiving Social Security pensions and RMDs, or is it just a matter of running the metric calculations?
I don't see many, so it's a good question. As a matter of fact, we don't see as many people retire with pensions anymore. Now, unless they're coming out of the government, we have had some cases where people had very substantial governmental pensions. So when there was a baseline of taxable income, pension and Social Security, I have seen the Roth conversions not to add as much value. And that's not always the case, and this is why it's so important to understand the metrics that are important to you. If somebody really wanted to provide more to the next generation on a tax-free basis, or really wanted a bucket that maybe a surviving spouse could tap tax-free, it could change that. We've also seen some very high net worth, high income earners where they're really focused on that generational planning, where they've done some substantial Roth conversions. But for the average person that has the pension and the Social Security income already, I have found that generally the Roth conversions aren't adding a ton of value.
Question about the YouTube channel. Would you please send a link to the new YouTube channel? What are the plans there, Dana, for letting people know how to access it? Would people who've been on webinars before get information about it?
You know what? I don't know.
I know. I was thinking the same thing. Like, it's a great question. I'm not sure.
Yeah, I mean, certainly if you are signed up for our Financial Sense newsletter, it's free. You can sign up at sensiblemoney.com. If you are signed up, to receive notifications of our webinars, then we will be sending it out. But it's Making Retirement Make Sense on YouTube. And I know we will be getting the word out when it launches. We're right now recording enough content that we can launch with some content. We don't want to launch with one piece of content. Right. So we're in the midst of the next few months recording, getting enough content to launch.
This is not a question, it's more of a commentary, but I love it. Why do we hate IRMA so much? Isn't it a funny emotional thing?
I know. And so it kind of circles back to the last person's questions. Do some people bump up, on purpose? And yes, it is okay to take IRA withdrawals and have to pay more in Part B and D premiums. It is okay. We don't like it because it just feels like this tax because, I took more out and I didn't even earn more, right? All I did was take more out of this bucket instead of that bucket. I get it. That's why we hate it. It just seems arbitrary, right? But it is what it is. Life isn't fair. It's one of the things I try to emphasize to young people. Maybe that sounds cruel, but it's not. Life doesn't owe us anything, and it is what it is. And I try to say, well, how do we focus on reality here? It is what it is. And then if we're really big about trying to change something, we can work on lobbying and try to get something changed. But right now, it is what it is.
Mm-hmm. Social Security question, Dana. What are your thoughts about the Social Security Trust Fund being depleted by 2033 or 34 and a potential cut in benefits by 20 to 25%? Are you accounting for this potential reduction in your planning process?
We can if someone wants us to. So it's really easy. It's a click of the button that just says, assume benefits are 25% less. And so I would ask you that, Nancy. You have some clients, I think, that have asked to account for that.
We have. So we've run both scenarios, both what we think is the case, which is that they will not be reduced, but no guarantees there. But also running it to show we've run showing no Social Security, which I don't think is necessarily realistic, and then maybe reduced. Yeah. But at least there's a sense of, okay, if this happens, we're still going to be okay, or more importantly, this is what we would do and how we would adjust if things change.
Yeah, and I just made this comment on LinkedIn. So I started in this business in 1995, and I had people then saying, no, don't include Social Security in my plan. I want you to run my plan without Social Security. And so we would do that if that's really what someone felt strongly about. And same today. I can absolutely see why someone would want to run it as if they get 75 to 80% of the benefit amount, not the full 100%. And so we'll run those plans. In terms of what we think is going to happen and what most of the people who are really more involved in the Social Security system think, we think that that's not going to happen. Right? We think that legislatively they will find a solution. And if you look back in history to 1983, this happened before. Unfortunately, they were months from the system supposedly becoming insolvent. And then legislatively, they took action, and full benefits continued. That's when that changed. The full retirement age schedule came into play, and along with some other changes. So we think there's changes that aren't going to be massive on any one person. We could see workers paying a larger portion of their income into the system. There's a combination of things that can bring this back into the metrics where we would want to see it, but it just politically, it's like what I worry about the most is they're going to wait until the last minute, and in the meantime, it leaves all this uncertainty out there. It leaves a lot of people making a less optimal Social Security decision because of all of the uncertainty, and honestly, that makes me mad. But that's an area where I have written to my representatives and my senators, and I would encourage everyone to do the same, right? Tell them you want a solution. Tell them you don't want to wait until the last minute. You want to know what's going to happen. If benefits are going to get cut, fine, tell us, right? We can plan for that, but don't just leave it up in the air. So that if we could all rally and do that, maybe we can have an impact.
Yep. You're getting a lot of thumbs up there, Dana.
I see a lot of claps and thumbs up.
Yep. Is Dana expecting that Medicare costs will skyrocket in the coming years as the amount we need to pay for it?
I don't think so. We already use a higher inflation rate than what we use on other living expenses. We have, if you read through the stats, some of the highest costs already and worst outcomes of developed countries' healthcare systems, which is another situation that, I don't know why. I know there's people trying to figure out why. It's another thing that I think just inevitably we're going to see improvements. I don't know how or when, right? But in my mind, it's like, well, it can't just keep getting worse, can it? Will we figure out, is it because of the way our insurance system works? Like, you hear all these stories of people and what they pay if they pay on a cash basis versus insurance, and just all kinds of stuff out there. So I think that in the next few years, we're going to see some changes that will keep that from skyrocketing, but I could be completely wrong on that.
Well, as I creep towards retirement, I'm hoping you are. So, how does your software differ from Monte Carlo simulation?
We have a Monte Carlo simulation built into what we use. And so every Monte Carlo is different. That is the reality. So some Monte Carlos, the way we do it is we start with a portfolio that after fees, so we assume portfolio returns based on what's called the lost decade, about a 60% stock, 40% bond return or allocation. And then we subtract out fees because we want to have a baseline of just, making sure we're accounting for that. And then we look at the standard deviation of that portfolio was 13.85%. And so the portfolio itself earned, let's call it 6.5%. We subtract out 1.5% management fees. Our fees are not that high, but we're trying to account for all kinds of situations and underlying investment product fees. And so we get to 5%, 13.85% standard deviation. We run that through about 2,600 historical simulations, or actually not historical. These are just simulations, random simulations of return combinations. Now, I'm not a huge fan of Monte Carlo as the best test that's out there. There's a great article on Kitz's website. His website's called The Nerd's Eye View. It's by Derek Thorpe on Monte Carlo, and its pros and cons. I love historical analysis, so we can actually, and that's one of the retirement readiness tests. We go back, we're like, okay, if this was your financial situation and your pattern of withdrawals, 1929, 1930, 1931, like, how did it work? I prefer that, but we use three different ways of testing and analysis, and each Monte Carlo is different. So it would be hard for me to say how ours differs. Some run simulations of everything all at once. That's very difficult, spending and inflation and portfolio returns and all kinds of things.
Yeah, I think that the fact that we have three very different ways of looking at a plan through very different angles is helpful, because I remember when Monte Carlo was first kind of rolled out for financial planning, and it was like, ooh, it was the answer to all the questions, and it's really not. So having the three different ways is super important. Yeah. We have someone asking about how he can subscribe to a newsletter, to our newsletter.
You should be able to go to our website. Let's see if I can find it. Well, you should be able to go to our website. I'm going to try to pull it up right here.
We can actually, or we could maybe include
we could send it out in a follow-up, but if you go, I assume it's all the way at the bottom. Yes, it's all the way at the bottom in the footer of any page, free financial tips, and then you can subscribe. So I found it. Yay.
Okay. Let's see. Looking forward, do you think the general inflation rate should be treated differently than a healthcare rate?
Looking forward, that's a great question. I mean, so far, no. We already treat it differently, right? And so that's probably why my brain kind of stopped. I'm like, well, it's been like 10 to 15 years of already using 3% as a baseline inflation and 5% on healthcare related. And so we already treat it differently. And so in my view, I would just continue using those set of assumptions that we currently use. And every year we're updating a plan. So it's one thing to do a one-time plan. It's like a snapshot, right? I've talked about the analogy between a photograph and a movie, but in real life, what we're living is a movie. And so every year you're updating based on reality, resetting that baseline, retesting, retweaking. It's one of the things I get so excited about the general metrics is if these metrics look good from this baseline, this set of actions is likely going to improve your outcomes. Well, then I know every year as it gets tweaked, the potential improvement is probably much larger even. Tax rules change. Obviously, we've seen that. the amount of investment growth you have changes from year to year, and that can change what you should withdraw from and when. So same with inflation, right? We had 10 years of almost 0% inflation. So even though we were projecting 3%, that wasn't materializing. Now we've had this period of higher inflation. I think over time it evens out. And then every year, if you're adjusting, you're resetting the baseline.
Question about a situation. So if we have enough money to fund out 35 years at 4% with a 99.9% chance of success, I'm assuming that's a Monte Carlo result, should we still invest in stocks? Do we take risks if we already won?
I think that's a great question. And it's a really personal one. We calculate something we call someone's minimum required return to have their plan work. And sometimes we'll have a minimum required return come back at 0 or 1 or 2%. And that leads to one of our questions is, well, you can view this two ways. One, I don't need to take any risk, right? I could ladder out treasury bills, CDs, bonds, whatever your safe investment of choice annuity is, and be just fine. The other is I can afford to take risk. And so it's a really personal question. What I think can help is that retirement income style awareness questionnaire. And as I said, we will send a link out in the follow-up email if you want to take it. So, that questionnaire has a great way of helping you understand yourself and whether you gravitate towards situations that are more safety based, that would entail not taking risk, or more probability based, and what you're going to feel most comfortable with. Because that sleep at night factor is important, right? It is an important one. Me, I'm very comfortable with market risk. I would always have, probably 60% of my portfolio, if I was, following a plan and adjusting as I was going along, I would probably always have at least 60% in equity market-based investments. But it's what I do for a living. I'm very comfortable with it. And when I take that questionnaire, I'm very probability optionality based. So that makes sense. We're not all alike.
Well, how long do you typically plan for sequence of returns risk? And maybe you want to, if anyone's not familiar with sequence of returns risk is, it might be a good time to.
Yeah, so sequence of returns risk is basically, what I had said at the beginning of the webinar. You can retire and get a great set of market conditions, and your portfolio is going to, grow, even though you might be withdrawing quite a bit. And you can retire and get one of the worst set of market conditions. Historically, that would have been retiring either in the Great Depression or right around 1968. And the stock market during that time, went up and down, but really didn't make any forward progress for almost 15 years. Now, a lot of those historical simulations use only the S&P 500, only US large cap stocks. As you start layering in diversification, it can change some of those historical metrics. So know that. But that sequence of returns risk, to me, there's two components. One, if I retire into a really bad market, well, it's just my outcomes, no matter what I do, aren't going to be as good as if I retired into a multi-year bull market. That's the reality. So we test based on that, because if we get great markets, we're all going to be fine in retirement. The second element is behavioral. So if I get a poor sequence of returns or a big market crash, and I panic when I retire, or I sell investments during that downturn because I didn't have any set aside in a safe place to draw from, well, that's going to compound the results. And so from that aspect, we like to see typically a 5 to an 8 year, what we call income ladder, that helps provide a buffer. If I get a really bad sequence in those first 5 to 8 years, well, I'm going to be drawing off these bonds or CDs that are maturing, so I don't have to sell any of those other investments that are in the downturn. And that helps from a behavioral standpoint. So it's hard to say what time frame. What I can tell you is the 4% rule, was based on, I just did an interview with Bill Benjen, who came out with a new book. I think I have it sitting here on my desk. Yes, A Richer Retirement, Supercharging the 4% Rule. And he was the original author of what became known as the 4% Rule. And so here's what was interesting. His research, one, it only used two asset classes, US large cap and intermediate term government bonds. It was the 4.15% rule, but he thought the 0.05 implied too much precision. He's an engineer by background. Well, yeah, we don't have that much precision. It was just a starting place for him to try to do some historical testing. And so he rounded down to 4.1, and then the media ran with it, and they rounded down to 4. And now we see comments in blog posts and online forums all the time that people start with 4%, and then they round down even more. And what happens in his research is most people end up with, in cases, 5 times more money at the end of retirement than they had at the beginning, because that 4% rule was based in his new research on one of 349 historical scenarios, the worst case one. So everyone following that is already saying, well, I'm basing my plan on as if it was the worst case from day one of retirement. But 348 people didn't get worst case. And so this is why I think a more dynamic approach makes sense, of saying, okay, well, let's start here. And then every year we adjust based on actual market conditions. And, Bill basically said that too. He said, I never meant this to be a rule. I adjust it every year. He said, right now I'm withdrawing 5.5%. And he feels like that's the new kind of, safe amount. But he said, next year I might change it. So it wasn't designed to be this, this is the amount, and then I just stay under this threshold. It was designed to be more dynamic.
Best practice, what % of expenses covered should we be targeting as we age? I think coverage ratio.
So it depends a lot on your demographic, your total net worth, right? So, for many households, if you've followed my content in the past, I'll say about 50%. But there are many high net worth households where that would be too high. They may have a lot of money tied up in property or a very large portfolio, and they wouldn't actually need that 50% coverage ratio. So when I think of a household with, let's call it $500,000 to $3 million of total assets, if it's less than 50%, then we might have a conversation with someone to say, is this of concern? Do you like the concept of having more guaranteed income? The retirement management advisor training that I and Nancy and most of our advisors have segments people by their household demographics and then looks at solutions that are more important for some demographics than others. And having more guaranteed income can offer more protection with lower net worth households. It just provides more security. The other tool that can be really useful is, again, the retirement income style awareness questionnaire that can help you determine if you gravitate more toward those solutions. We had one very high net worth household put $2 million into immediate annuities. This was probably about a decade ago now. They were very spooked by the Great Recession, and they wanted that level of guaranteed income. So we can have some general, I like to look at, it being at about 50% or higher, but then you have to tweak that for all of the underlying factors.
My husband just turned 69 and continues to work because he's enjoying it. He's working free with a startup and also has a regular job. He tells me to be ready for any scenario. Retire next week, retire at 70, retire in 5 to 10 years. As long as he's having fun, he wants to continue. We're currently in good shape, I think, but I really can't tell a financial planner when we'll stop receiving work income because I don't know. Right now, I feel like I'm having to plan for all scenarios. Can a planner still help us and add value if I don't know when he'll retire? And all I can say is multiple clients where it's, well, if you retire here, if you retire here, if you retire here, we can literally do it every year, going forward.
Yeah.
It's not difficult.
Yeah, I've had that, with clients who are like, well, I might retire next year, but I really like what I'm doing, so I might retire in 5 years. What we like to do is then every year I run the plan as if they're retiring next year, because that's the most conservative way to do it, right? And I can structure the portfolio that way so that they can pull the trigger at any time and know that there's bonds and safe investments maturing to draw from. But if they don't need them, then those just get reinvested into the portfolio. And it really allows that, hey, you can feel comfortable anytime you want to walk away. We can just flip the switch and you can draw your paycheck from this retirement portfolio. That's how we like to approach those situations.
Does your Roth conversion analysis consider where tax payments need to come from? Do you see it makes sense to pay the taxes from the IRA?
There have been cases where we pay the taxes from the IRA, but in general, I don't like it. In general, Roth conversions make the most sense when I have some non-retirement assets to pull from, and I can use those to pay the taxes. But yes, we do have to take that into account in the analysis.
When is the next webinar and what is the topic?
The next webinar is going to be in January, and it's going to be on how to make a retirement income plan. It's another one that we typically do every year, and I will be doing that jointly with one of our firm partners, Amy Shepard. It should be on the bottom of our website, but I don't know. Let's just see. I will refresh and see if they've updated it yet. Nope, they haven't updated it yet, but it will show up on the homepage of our website as soon as they have it posted. And then what I'm hoping is that we will have more webinars next year. So I really want to do one on financial fraud. If anyone has topics they'd like to see, pop them into the comments right now. I'd love to know if there's some specifics that you would like to see. If you are one of those people who felt overwhelmed by the information and you'd like to see something very simple on a certain topic, I would love to hear that. So feel free to pop it in the comments. You can shoot us an email at info@sensiblemoney.com. You can follow me on LinkedIn or on X. My X handle is @moneyover55. And I would love to hear some things that people really want to hear about and see.
Are you a fiduciary and what is your fee structure?
We are a fiduciary, and that just means we have a legal obligation to put your best interests first. Our fee structure is a little unique in that we do a plan for a fee for everyone first. And that planning fee is typically $6,900, although it can be higher for people who have very complex situations. It can be as much as $8,900. And we don't just take over investments. So that plan is something that we think everyone should do. It's always odd to me that you would meet with a planner once or twice and go, yeah, here's all my money to manage. So through that plan, it's a very comprehensive engagement. It encompasses a series of strategy meetings where we cover different topics, not all at once. We really try not to overwhelm you and break them into short little topics. And then at the end of that plan, you have a really good idea of what we do and whether you like the way we work and whether you want to engage us on a longer term full service basis where we work under assets under management. And then we have an assets under management fee if you move to that service model, and that's where we are doing the planning and tax planning every single year and managing the investments.
Yeah. In the flight path example, how did you arrive at the present value for Social Security?
Same way as the other present value calculations. So you look at the cash flows coming in over their lifetime and you back that into today's dollars using a 3% discount rate.
Okay, I'm going to do a check-in. Dana, how are you doing? How are you holding up?
I'm doing good. I think we can take 2 more and then we'll wrap up. Okay.
I have, I can't get to anything else on my screen because this is all broken out. So every once in a while I hear a ding and I'm not sure if that's coming from you. So
No, it wasn't
Thought I
from
would
me.
check.
Yeah, we have a ton of questions, and I
Yeah,
know I'm guessing, it
we're,
was over 500 live attendees, probably even
yeah,
more, just based on the number of people that participated in the polls. So
yeah,
if we didn't get to your question or can't get to it, we're sorry.
yeah. Um, oh, I was just with the changes to ACA subsidies coming in 2026, planning on pulling in some more taxable events this year. I have a few in mind, but interested in your thoughts of what potentially to consider. So I was looking for what would
That's
be.
a good strategy. So, if you will potentially, want to bump more income, but I guess it would depend, right? Are you already on an ACA subsidy this year? So if you pull more income into this year, you lose some of that credit. So I don't know enough. But if I wanted to pull income into this year, I might, especially with market appreciation, I might be selling things that had appreciated in taxable accounts. I don't know if I'd be doing Roth conversions though, if it would eliminate my ACA subsidy. So it's hard to know. The general things are Roth conversions, realizing capital gains, taking IRA distributions.
Is there a difference between 8% expected return with 3% inflation versus a 5% real return?
Well, here's why I don't like to use real returns. So, and we are using real returns in a different way, right? We are inflating expenses, and then we're using a return on the portfolio and calculating out the cash flows. So we have all the factors built in there. But if I use just a real return on a portfolio, it's like not all my income's coming from the portfolio. Some of my cash flow is coming from my Social Security. Sometimes I might have a mortgage that doesn't have, it's not an expense that's going up over time. I have different expenses going up at different rates. And so to me, that idea of taking an 8% return and assuming after inflation, it's going to earn 5. So I don't know. It just never quite made sense, because where it would make sense is if that's it. I just have one account earning this account, and I want to know after inflation, would my withdrawals approximately keep up if they were going to be the same each year? But we just don't see that's what really happens in real life households. People's withdrawal amounts and their needs vary all over the place, particularly in that first decade of retirement. And so, anyway, it is one way of accounting for inflation, but it's not my preferred way.
Mm-hmm. How much would paying your firm affect the amount I have left at the end if I had the amount of money that the couple in your example? I've always invested myself, and I'm concerned how much it would cost me in the long run to hire your firm.
Well, in that example, we're already assuming that those returns they earned were after all fees. And so that's how we run the analysis, but we don't know exactly. And the reason is, this came up on a podcast I was on a few weeks ago of like, wasn't there a conflict of interest in terms of, whether you're helping people spend money? And we have some clients where we help them spend money so rapidly that today they have half the amount they retired with. That's not a bad thing, because it was on purpose, right? And so they paid us less and less and less each year because that was the plan they wanted. And so we don't know, exactly how much you would pay us over time. We can do estimates. You can do estimates. I think what people do is they forget about value. And so if we're able to add enough peace of mind and value, and a lot of research put out by Vanguard, there's Russell Investments, there's numerous firms that have tried to quantify the value that financial advisors add. And so it's really, are we earning back those fees for you, right? Not just in a quantifiable way, but improving your life, improving your ability to spend, improving your peace of mind. And we get love letters from clients all the time. And I know it's not for everybody. Some people are they want to do it themselves. They're not delegators. They just look at price and they can't see the value. That's okay, right? Maybe working with an advisor is not for you, but we have lots and lots of people who literally send us love letters like, we can't believe how much we're enjoying retirement. We couldn't have done this without you. Thank you so much for, I mean, we just had someone submit a survey result that said that their experience with us was nothing short of life-changing. I couldn't even believe it when I read that, but for some people, it is that much value. But I know that's a long answer. We care about what we do, but we want to work with people who are looking for that partner, right? They're looking for that partner to delegate with, to build that trusting relationship. And we understand that's not everyone, and that's okay.
I'm a fan of die with zero and give less money early to kids. I'm a fan of die with zero and give less money early to kids early and then have young children and could use it more now. How can this play into your fundedness plan? I agree a buffer is needed, but not go to zero. So it almost sounds like, how can I spend as much as possible? Like how would we measure that, but without running out, without going to zero?
Yeah. I think that's great. And I think what you're probably saying, you're a fan with die with zero and you'd like to help your children now more while they have young children. That's probably what you're saying. And so we just build in the extra spending. Now, what I like to do is build it in a few years at a time. So there's been times where I've said, look, we use very conservative metrics. So I'm going to build in this extra spending for 5 years. But every year, I'm going to add on a year. So when I update your plan next year, I'm going to roll it forward 5 years, and next year and so if I were to put that extra spending in from day one for the life of your plan, you go, that might not work. But if I put it in for 5 years, which most of us can think in shorter time frames, and I go, looks great, let's do it. Next year, yep, still looks good for 5 years. And usually that's because conditions actually are better than our conservative scenarios. And that's what we like. It's just way more fun to every year be like, yep. So that's how we like to do it, is on a rolling basis.
All right, we have a couple more here. We've already talked about paying taxes from Roths, or paying taxes from external sources versus IRAs for Roth conversions. Can you explain again the meaning of the break-even points as you referenced in a couple of slides? So this was early on in the presentation.
Yeah, so let me see if I can, I don't know if I can go back, but I think I can. Fast forward. So break even would say, if I am delaying Social Security in every scenario except for the blue one, right? I have to spend more of my own assets first. And if I'm doing Roth conversions, I'm going to pay more taxes on those conversions. But from that point on, it's going to grow tax-free. So at what point do my assets grow past if I hadn't done those things? That's what break even is, right? So if I am claiming Social Security right when I retire, then I'm going to watch my asset path grow. But later on, I'm not going to have the same amount of inflation protection, and I'm going to have to pull more money out of my portfolio each and every year because I'm not getting as much from Social Security. So then my asset path starts to decline. But if I delay Social Security and then I am spending some of my assets early, well, I break even out here 17 years. Now that includes a lot of other factors. The red over the blue would be just the delay Social Security. And that's why we don't necessarily, they all intersect, right? If I'm just delaying Social Security versus I'm delaying Social Security with some tax strategies, it moved up that break even. Now I've seen break evens that didn't occur for 25 years where I'm like, no, I don't like this tax strategy. It doesn't add enough value. and you didn't break even for 25 years. And I've seen ones that break even in 7 to 10 years where I'm like, oh yeah, you need to do this. Like this is huge. And again, we have to know all the factors to run the analysis. Like I can't guess. And every household, their age differential, the amount of Social Security, the composition of their assets, the amount of embedded capital gains, all of those factors intersect. But that's what it is. It's really trying to say, well, at what point do I have more money because I took advantage or used these strategies?
This is the last question, Dana, and I was looking for one like to end on a positive note. I don't know if this is, maybe this is a neutral note. Are bear markets, particularly secular bear markets, accounted for?
Yes, and so they're accounted for in 1, Monte Carlo analysis, 2, in our historical audit analysis. So we talked about Monte Carlo with one of the previous questions, and the historical audit is where we now take that pattern of cash flows that you just saw and then go back and say, okay, let's retire this person, every single year starting in the Great Depression and see what their path would have been based on the actual market conditions. And that, of course, incorporates all of the past bear markets, and so we can see exactly what would have happened during those times.
Okay, I think we're gonna call it.
We're gonna call it. I'm gonna find myself a big glass of water. My voice is getting scratchy. Thank you, everybody, and we'd love to hear your thoughts on the type of content that you find most valuable. Really appreciate all of you who took the time to join us today.